What's up, guys? It's Rob here, and today we're going to be talking about my favorite options trading strategy that I use every month pretty much to get some passive income going. Now, this option strategy isn't super risky. In fact, its probability of profit is pretty much 100%, right? You're pretty much guaranteed to be making money on this strategy if you use it how I outline in this video. However, this isn't financial advice. I'm not telling anyone to use this strategy, but I do want to point out that it's not one of these crazy risky options trading strategies that people can use to turn 10 bucks into $1 million overnight. All right, this is more so a passive income strategy that you can use to get reliable profits over a period of months or years. So we're going to jump right into it and start explaining what it is. And some of you may have heard of this before, but it is called selling covered calls. Now, for those of you who don't know what calls are or aren't too well versed in options and how they work, I will be doing a brief explanation right here, giving you guys a calls lessons. And if you guys are not interested in that, if you already know how options work, then feel free to skip forward to a bit further in the video. I'll put a timestamp on when I'm done talking about this. But for those of you who don't know what options are, here's a quick lesson on calls. All right, this isn't going to be the most in-depth lesson, but I will explain how call options work at least so you guys can understand what I'm talking about in the rest of this video. But owning a call option gives you the right to buy a stock at a specified price by a specified date, okay? So options are derivatives that are traded on stocks, and when you buy them, you pay for them, and then you have the option to buy a stock at a specified price by a specified date. Now, there are three key terms that you'll need to understand for this video, okay? First is the strike date, and this is when the option expires. So it's that specified date by which you must either use the option to buy the stock or not, right? You don't have to do it since it is an option. You don't have to buy the stock for the price if you don't want to. The second term is the strike price, okay? And this is the specified price that you come up with at which you can buy the stock. And oftentimes the reason people use options is because they want to set a strike price that's higher than where the stock is, but that the stock is not at yet. And in case the stock explodes and becomes worth a whole lot more than that price, they want to be able to buy it later on for a much lower price than the stock is currently trading. And the third thing that you'll need to know is what the premium is. And this is what you pay for the option, okay? So you'll pay a premium upfront when buying an option, and that will be the money that you pay that gives you the right to buy that option for the strike price by the strike date. So that was hopefully a decent explanation of call options. You probably needed some background knowledge to understand it, but we will be moving on to the example of what you'll actually be doing if you decide to partake in this strategy as I do. And we're going to be using first an imaginary ticker, then we're going to use a real life example at the end of this to hopefully better exemplify it. But first off, we'll just do this with easy numbers and the fake ticker ABCD. So imagine that there is a stock ABCD trading for $10 per share, and that you then want to sell call options on it, right? You can either buy or sell. We're talking about selling call options. Usually when people are talking about options, they will be buying options. That's a lot riskier because you need the stock to actually make a move in order to make money. When you're selling the option, you don't need the stock to do anything to make money. In fact, it would almost be ideal if the stock price stayed the same as we're about to explain. So let's say there was a stock, ABCD, selling for $10 a share, right? That's what it costs to buy the stock. Maybe you end up buying 100 shares of the stock because in order to sell an option, you actually have to have at least 100 shares of the stock, at least a call option if you're doing a covered call, because each options contract is equivalent to 100 shares of stock. So say you buy the stock for $10 per share, and then you want to sell the $11 call option, right? $11 is the strike price, and the option premium, let's say that's $1, and the strike date, let's say it's about a month away, right? About a month from whatever day you end up making this trade on. So you buy the stock for $1,000, you buy 100 shares of it for $1,000, you sell one call option on it, and you collect a $100 premium, right? Because you multiply the dollar by $100, that's the premium per share. And you're trading option when you're trading options, it's always for 100 shares of stock, and the strike price is still a month away. So let's go through a couple of the scenarios that could play out price-wise over the course of the next month that could either lead to profits or losses on this trade. So the first option is, right, the first way this could go, let's just assume it goes really well, and this stock, let's say it explodes to $20 per share, right? So normally if you'd bought the stock, you would have just doubled your money. That won't actually be the case if you've sold an $11 strike price call option on it, right? Because this call option is for $11. So past $11, you won't actually be making any profit. So this would lead to a 20% profit, which is the max profit you can make on this trade because you bought the stock for $10 per share. And then if the call option expires in the money, then you would be selling it for $11 per share because that's the strike price. And that's regardless of what price the option itself is, or what price the stock itself is trading at. So if the stock is trading at $1 million per share, you're still selling it at $11 per share when that strike date comes around. But in addition, you also get the option premium of $1, okay? And it's actually very unlikely, right, that in the course of a month, a stock is going to pop off 20%, depending on the stock. Some do, but oftentimes, if you're just doing this every month, imagine collecting a 20% profit every month. If the stock goes up, it would only have to go up about 10% for you to collect a 20% profit. But that's what happens if the stock is over $11 per share. Now, let's say the stock doesn't do anything at all. Let's say it was at $10 per share and it remains at $10 per share. It stays exactly where it was. Well, in this situation, you would actually get a 10% profit during the course of that month, and no movement is required for this profit because you collected the $1 call option premium. Multiply that by 100, that's $100 on your $1,000 trade. So you still own the stock, you still have it. It's sitting at $10 per share at the end of the month. It hasn't moved at all, but you got to keep that $100 of premium. So that's pure profit that you're getting, and the stock didn't even have to move at all. That's the really cool part about this strategy, that you don't need the stock to go up to make money on it. In fact, it could even go down a little, right? If it went down a little bit, you could still make some money on this because of the premium you're collecting. Now, let's say the stock does go down. Let's say it goes down to $9. This is actually your break-even point, right? No profit or loss. It doesn't matter, how far the stock goes down. As long as it's above $9 or at $9, you're going to be either making money or keeping the same amount of money that you've got because, you bought the stock for 10, it's down to 9, but you did collect a $1 premium on the stock. So you actually didn't lose any money over the course of that month, even if it is trading a dollar below the price that you bought it at, because you collected the money up front for the option when you sold it. So let's look at the last example, and that would be if the stock goes down below $9 per share. That's the only situation in which you're actually losing money, in which case, this strategy would not be profitable, but it would have to drop quite a bit, right? Over the course of the month, the stock would have to drop more than 10% to break even on it. So obviously, even if you just bought the stock, hopefully you're just doing this strategy with stocks that you like. But let's say you bought the stock for $10, it drops down to 8. Well, then you've lost $100 on the stock because normally you would have lost $200. Normally, $10, a $10 stock that was $1,000 worth of stock that you bought. If it drops down to 8, that would be $800 left that you would have. However, you sold the $1 call option, so you got $100 worth of premium when you sold that. So it's really only a $100 loss in this situation. So it even ends up being a smaller loss than not selling the call option, just using this strategy. It's pretty profitable most of the time, and we're going to see exactly what I'm talking about by looking at PROG. Okay, real life example, PROG stock right here. Currently, PROG is trading for $3.74. It looks like. Let's just say it's trading for $3.75. There we go, $3.75. So let's look at the PROG options. Let's say you wanted to use this strategy on PROG, first of all, and we're going to buy 100 shares of PROG. That would cost you $375. And then if you look at the options for PROG, the first thing you need to do is select a strike date. Today is November 24th, so we'll look at December 23rd, about 1 month out. And then looking at the call options available, you could say maybe you think the $5 call option looks good, right? You think that PROG could potentially go above 5. You don't know if it will. It's at $3.75 right now, so it would have to rise by $1.25 to get there. And you then want to sell the $5 call option because you have a feeling that PROG will end below that, right? You don't want to actually sell call options that you think would expire in the money. But let's say you sell the $5 call option, right? It says 50 cents right here of premium, and that's per share, so multiply it by 100. So you're getting $50 of premium to sell PROG, to sell a PROG option for a $5 strike price by December 23rd. So if you think that PROG is going to be below $5 by December 23rd, or even if you don't, if you think it's going to be below $5.50 technically because you are selling this call option for 50 cents, you're still making more money selling the call option than you would by selling PROG on December 23rd for $5 and say 10 cents because you are collecting an instant 50 cent premium right now, then you could be making a decent percentage on your money just by selling this call option. And then you have some protection to the downside if PROG ends up moving down. Say PROG moves down to $3.25. That's actually your break-even point, right? You didn't actually take any loss on PROG if you were, say, buying it right now at $3.75. If it moves down 50 cents and you've sold this call option for 50 cents, then no big deal because you've actually been break-even over the course of the month. So it does protect your downside a little bit. And it does provide you the opportunity to make some profit if PROG, say, doesn't move at all, right? If it stays at $3.75 for the next month, or at the very least, if it ends December 23rd around $3.75, then you would essentially just be collecting this 50 cent / $50 premium for nothing, just for holding PROG stock. So that's just a quick example looking at PROG. That's a potential way that you could be making money on this with this stock, right? That's a potential strategy that you could be taking. And I do tend to really like using this strategy to make money on stocks that I have a high conviction in, right? Ideally, you're using it on stocks that you believe in anyways. You don't necessarily want to buy stocks that you think will fall a ton, because if they do end up crashing, you can lose some money on the strategy, right? It's possible that the stock could fall enough so that you would still be down on money, even though you've sold the call option and collected the premium. So it is somewhat dangerous, right? Doing this every now and then, you can lose money, but that's why it's important. Why ideally you would be using this strategy just to sell call options on stocks that you either already own or have a conviction in that you think will be doing well over the long term, but that over the short term might be just kind of volatile and not moving up or down all that much, kind of just staying stagnant. So that is a way to potentially make some money with call options. That's one of my favorite strategies, I've got to say, to bring in income every month, because either way, if the stock stays where it is or if it goes up, you're making money. And even if the stock goes down, you're still making some money, depending on how far down it goes, right? Obviously, there's a point at which you are losing money on the stock, but if you're going to be holding the stock anyways, you're only getting more money in than you would have otherwise had. So that's my opinion on selling covered call options. And if you guys are interested in more options tutorials, feel free to say so in the comments, like the video, and I'll probably make more of these kinds of videos in the future. But other than that, guys, hopefully that was a decent explanation. And you should know that this is not financial advice. I'm not recommending that anyone do this. Obviously, you should look into it a lot more. You shouldn't just take my word on it. You should do some research into selling covered call options if you wish. Feel free to ask questions in the comments, but this is not financial advice. I'm not recommending anyone do it. So other than that, guys, have a great day. I'll see you in the next one. Bye.